Welcome to the Training and Advisory Services online course. In this course, we'll focus on the conceptual framework. Does it form part of the standards? The conceptual framework serves as a basic point of reference for policy making on specific issues. It also sets out agreed concepts that underlie international financial reporting standards, IFRS financial reporting, but it does not form part of the standards. We'll look at an overview of the conceptual framework where we focus on the purpose and status, its objective, which is linked to the underlying assumption, the elements, as well as the qualitative characteristics. The understanding of the accounting treatment framework will aid in better understanding of how IFRSs are structured and enhances comprehensive application of the IFRS requirements to a particular accounting issue by students, preparers, or practitioners. The framework deals with the overview noted above, which we'll look at in detail. The objective. The objective of the conceptual framework is to provide information about the financial position, performance, and changes in financial position of an undertaking, useful to a wide range of users in making decisions. For example, investors, lenders, employees, and government. The framework is concerned with financial statements, including consolidated financial statements. Now, financial statements are a summary that users make use of for analysis of financial information. These are presented at least annually and are directed towards the needs of a wide range of users. For example, investors. These are the providers of risk capital and their advisors, and they are concerned with the risk in and return provided by their investments. They need to know whether they should buy, hold, or sell, and the ability of the undertaking to pay dividends. Employees. Employees and their representatives are interested in the stability and profitability of their employers. They are also interested to assess the ability of the undertaking to provide remuneration, retirement benefits, and employment opportunities. We also have lenders who wish to know whether their loans and interest will be paid when due. And the government is one of the other key stakeholders, and through its various ministries, it has different uses of financial statements. But there are some needs that are common to all users, and some users can obtain information in addition to the financial statements, but many users have to rely on the financial statements as their major source of financial information. The objective of financial reporting. Due to global markets and globalization of economies, there was increased importance of standardizing or making use of common frame of reference, harmonization financial reporting. Now, the provision of financial information about an entity to external users that is useful to them in making economic decisions is the definition of objective financial reporting. And it is important for assessing the effectiveness of the entity's management. Now, financial statements are a principal way of providing information to its users and the summary of the performance and financial position of the entity for the reporting period. Financial statements also reflect the stewardship of management and the effectiveness with which they managed the assets that they had and how they financed those assets. Qualitative characteristics of financial statements. Now, as part of our primary users of accounting information, we have capital providers and their characteristics, and their constraint is cost. Now, in order for their decision to be useful, the information has to satisfy fundamental characteristics, which are relevance and financial and faithful representation. And the enhancing characteristics would be comparability, verifiability, timeliness, and understandability. The qualitative characteristics of useful financial reporting identify the type of information likely to be most useful to users in making decisions about the reporting entity on the basis of information in its financial report. The qualitative characteristics apply equally to financial reporting in general purpose financial reports as well as to financial information provided in other ways. The following are fundamental characteristics. Relevance. The information is relevant when it helps users evaluate past, present, or future events, or confirms or corrects their past evaluations and is affected by its nature and materiality. In some cases, the nature of information alone is sufficient to determine its relevance. The information should have both predictive value and confirmatory value. Faithful representation. General purpose financial reports represent economic phenomena in words and numbers. This fundamental characteristic seeks to maximize the underlying characteristics of completeness, neutrality, and freedom from error. Information must be both relevant and faithfully represented if it is to be useful. The following are enhancing characteristics. These are desirable, but less critical than the fundamental characteristics. Comparability. Information about a reporting entity is more useful if it can be compared with similar information about other entities and with similar information about the same entity for another period or another date. Comparability enables users to identify and understand similarities in and differences among items. An important implication of comparability is that users be informed of the policies employed in the financial statements, any changes in those policies, and the impacts of such changes. For example, comparing 2018 financial performance to 2017, or Company X financial performance with Company Y for the same year in the same industry. Verifiability. This gives users assurance that information represents faithfully the economic phenomena it purports to represent. Different users or observers should be able to reach a reasonable consensus that a particular representation is a faithful representation through verification, for example, different auditors. Timeliness. Timeliness means that information is available to decision makers in time to be capable of influencing their decisions. That is why some regulators give deadlines for certain entities issuing financial information. For example, the Reserve Bank of Zimbabwe and its requirements on microfinance institutions, or the Zimbabwe Securities Exchange with listed entities. Understandability. Information needs to be readily understandable by users. Classifying characteristics and presentation information clearly and concisely makes it understandable. These users are assumed to have a reasonable knowledge of business and accounting and a willingness to study the information with reasonable diligence. This comes to the end of part 1. We'll continue the slide in part 2.